Why cryptocurrency is better than commodities? The commodities market is a huge and integral part of our economy, with metals, energy, and food staples all being traded on a daily basis. However, there is another market that is quickly becoming just as important: the cryptocurrency market. Cryptocurrencies are digital assets that use cryptography to secure their transactions and to control the creation of new units. Bitcoin, the first and most well-known cryptocurrency, was created in 2009. Since then, the cryptocurrency market has exploded, with over 10,000 different cryptocurrencies in existence today with a total market capitalization of over $1 trillion. So, what's the difference between commodities and cryptocurrencies? Let's take a look. Please like, subscribe and turn on the notification button to keep supporting our channel. 1. What are commodities? What are commodities? Simply put, commodities are raw materials that are used to produce goods and services. Commodities can be grown, like corn, or they can be extracted from the ground, like oil. They can be mined, like gold, or they can come from animal sources, like wool. Commodities are an essential part of our economy, as they are used to produce the goods and services that we rely on in our daily lives. Without commodities, we would not have the food we need to eat, the clothes we need to wear, or the fuel we need to power our homes and businesses. While commodities are essential to our economy, they can be volatile, as their prices are often determined by global supply and demand. When there is more demand for a commodity than there is available supply, prices will increase. Similarly, when there is more supply than there is demand, prices will decrease. Investors often invest in commodities as a way to hedge against inflation or protect themselves from the volatility of the stock market. When inflation rates rise, the prices of commodities often rise as well, which can help investors maintain the value of their portfolio. If you're interested in investing in commodities, there are a few different ways to do so. You can buy commodity futures contracts, which are agreements to buy or sell a specific amount of a commodity at a set price on a future date. You can also invest in commodity-based exchange-traded funds, ETFs, which are funds that track a basket of commodities. Finally, you can invest in stocks of companies that produce commodities. No matter how you choose to invest in commodities, it's important to do your research and understand the risks before you get started. Commodities can be a great way to diversify your portfolio and protect yourself from inflation, but they can also be volatile and risky. What are commodities? Commodities are physical products that are standardized and interchangeable. Broadly speaking, commodities can be divided into two categories: hard commodities and soft commodities. Hard commodities are typically natural resources that must be extracted from the ground, such as oil, gold, and copper. Soft commodities are agricultural products that are grown, such as corn, wheat, and coffee. The commodities markets are where these raw materials are traded. Unlike other financial markets, the commodities markets are not driven by company performance or economic indicators. Instead, commodities prices are largely determined by global supply and demand. When there is more demand for a commodity than there is available supply, prices will increase. Similarly, when there is more supply than there is demand, prices will decrease. Investors often invest in commodities as a way to hedge against inflation or protect themselves from the volatility of the stock market. When inflation rates rise, the prices of commodities often rise as well, which can help investors maintain the value of their portfolio. If you're interested in investing in commodities, there are a few different ways to do so. You can buy commodity futures contracts, which are agreements to buy or sell a specific amount of a commodity at a set price on a future date. You can also invest in commodity-based exchange-traded funds, ETFs, which are funds that track a basket of commodities. Finally, you can invest in stocks of companies that produce commodities. No matter how you choose to invest in commodities, it's important to do your research and understand the risks before you get started. Commodities can be a great way to diversify your portfolio and protect yourself from inflation, but they can also be volatile and risky. 2. What is cryptocurrency? Cryptocurrency is a term describing digital tokens based on blockchains such as Bitcoin, Ethereum and Litecoin. Cryptocurrencies are decentralized and often open source. Tokens are often issued in an initial coin offering, to raise funds. Cryptocurrencies are digital or virtual tokens that use cryptography to secure their transactions and to control the creation of new units. Cryptocurrencies are decentralized, meaning they are not subject to government or financial institution control. Bitcoin, the first and most well-known cryptocurrency, was created in 2009. Cryptocurrencies are often traded on decentralized exchanges and can also be used to purchase goods and services. Bitcoin, the most well-known cryptocurrency, can be used to purchase goods and services online and in brick-and-mortar stores. Ethereum, the second largest cryptocurrency by market capitalization, is used to create decentralized applications and smart contracts. Cryptocurrencies are often volatile, meaning their prices can fluctuate rapidly. Bitcoin, for example, has seen its price swings from below $200 in 2015 to a high of nearly $20,000 in late 2017. Cryptocurrencies are often used as an investment, either to hold for long-term appreciation or to trade for short-term gains. Many investors believe that cryptocurrencies will eventually replace fiat currencies, such as the US dollar, as the preferred global currency. What is a blockchain? A blockchain is a digital ledger of all cryptocurrency transactions. It is constantly growing as completed blocks are added to it with a new set of recordings. Each block contains a cryptographic hash of the previous block, a timestamp, and transaction data. Bitcoin nodes use the blockchain to differentiate legitimate Bitcoin transactions from attempts to respend coins that have already been spent elsewhere. What is mining? Mining is how new Bitcoin and other cryptocurrencies are created. Miners are rewarded with cryptocurrency for verifying and committing transactions to the blockchain. Cryptocurrency miners are rewarded with newly created cryptocurrency, as well as transaction fees from the users who send the cryptocurrency. What is an ECO? An ECO, initial coin offering, is a crowdfunding method used to raise funds for new cryptocurrency projects. ECO participants receive tokens in exchange for their contributions. These tokens can be used to access the service or product the project is offering, or can be traded on cryptocurrency exchanges. What is a wallet? A wallet is a digital place to store your cryptocurrencies. It can be used to receive and send tokens. Bitcoin and other cryptocurrency wallets are not like physical wallets, they do not store currency. Instead, they store the private keys that are used to access your public key, your cryptocurrency address. What is a private key? A private key is a secret code that allows you to spend your cryptocurrency. It is important to keep your private key safe, as anyone who has access to it can spend your cryptocurrency. What is a public key? A public key is a code that allows others to send cryptocurrency to your wallet. It is important to keep your public key safe, as anyone can send cryptocurrency to it. 3. How do commodities and cryptocurrency compare? In the past decade, we've seen a rise in commodity prices and a corresponding increase in interest in cryptocurrency. Both are assets with the potential to generate significant returns, but they have very different characteristics. Here, we compare and contrast commodities and cryptocurrency, and explore the investment potential of each. Commodities are physical assets that are used to produce goods and services. They include agricultural products, energy, metals, and minerals. Prices for commodities are driven by supply and demand, as well as by geopolitical factors. Cryptocurrency is a digital asset that uses cryptography to secure its transactions. Cryptocurrency prices are driven by demand from buyers, sellers, and speculators. Commodities have a long history as an asset class, dating back to ancient times. Cryptocurrency is a relatively new asset class, with the first Bitcoin transactions taking place in 2009. There are a number of key differences between commodities and cryptocurrency. One of the most important is that commodities are physical assets, while cryptocurrency is digital. This means that cryptocurrency is more easily bought and sold than commodities. Another key difference is that commodities are regulated by governments, while cryptocurrency is not. This has led to concerns about the legality of cryptocurrency and its potential for use in illegal activities. Finally, cryptocurrency is much more volatile than commodities. Prices for Bitcoin, the best-known cryptocurrency, have risen and fallen sharply over the past year. This volatility can make cryptocurrency a risky investment. 4. Which is a better investment? When it comes to investing, there are a multitude of options available to individuals. 2 popular investment types are commodities and cryptocurrency. Both have their own benefits and drawbacks, so it's important to carefully consider which is the better investment for you. Commodities have been around for centuries and are a staple in many portfolios. They offer a tangible asset that can be traded and sold on the open market. Gold, silver, oil, and gas are all examples of commodities. Cryptocurrency is a newer investment option that has gained traction in recent years. Bitcoin, Ethereum, and Litecoin are all examples of cryptocurrency. Cryptocurrency is digital and not backed by any physical asset. When it comes to choosing between crypto and commodities, there are a few things to consider. Risk. Both crypto and commodities come with a certain amount of risk. However, commodities tend to be less volatile than cryptocurrency. This means that they can be a more stable investment, especially in the long term. Returns. Both crypto and commodities can offer investors good returns. However, cryptocurrency has the potential to offer higher returns than commodities. This is because it is a newer asset class and has more room to grow. Liquidity. Cryptocurrency is more liquid than commodities. This means that it is easier to buy and sell cryptocurrency on the open market. Commodities can take longer to sell due to their physical nature. Fees. Both crypto and commodities come with fees associated with buying and selling. However, crypto tends to have lower fees than commodities. This is because there are no costs associated with physically storing or transporting crypto. Which is better? There is no easy answer when it comes to choosing between crypto and commodities. Both have their own benefits and drawbacks. Ultimately, it depends on your investment goals and risk tolerance. If you're looking for a more stable investment with less volatility, then commodities may be the better choice. However, if you're looking for the potential for higher returns, then cryptocurrency may be the better investment. Cryptocurrency pros and cons. Crypto pros. 1. Cryptocurrencies are decentralized, meaning they are not subject to government regulation or control. 2. Cryptocurrencies are global, meaning they can be used by anyone, anywhere in the world. 3. Cryptocurrencies are fast and efficient, meaning transactions can be processed quickly and cheaply. 4. Cryptocurrencies are secure, meaning they are difficult to counterfeit or stolen. 5. Cryptocurrencies are anonymous, meaning users can transact without revealing their identity. Crypto cons. 1. Cryptocurrencies are volatile, meaning their prices can fluctuate wildly. 2. Cryptocurrencies are not widely accepted, meaning they can be difficult to use in everyday transactions. 3. Cryptocurrencies are not insured, meaning they are not backed by a government or other organization. 4. Cryptocurrencies are not regulated, meaning there are no rules or laws governing their use. 5. Cryptocurrencies are risky, meaning they could lose all of their value. Commodities pros and cons. Commodities pros. 1. Diversification. Investing in commodities can help diversify a portfolio and protect against inflation. 2. Returns. Commodities have the potential to generate high returns. 3. Hedging. Commodities can be used as a hedge against inflation. Commodities cons. 1. Volatile. Commodities are notoriously volatile, which can lead to big losses. 2. Illiquid. It can be difficult to buy and sell commodities, especially in times of market turmoil. 3. Murky. The commodity markets are often opaque and difficult to understand. 5. Conclusion. So, which asset is a better investment? That depends on your investment goals and tolerance for risk. If you're looking for stability and modest returns, commodities may be a better choice. If you're looking for the potential for high returns, cryptocurrency may be a better bet. Don't forget to like, subscribe and turn on the notification button so that you won't miss any updates.